by. I'm so happy that we're here this morning. I was actually in the background saying I was going to give you 1 minute to get on, but maybe it was only 45 seconds. But we'll have the real people, the economists, who will be able to discuss if that was the right number or not. But it's not the number of seconds that we're waiting for them to talk. It is about to hear about what they're about to say. So I'm very pleased to be able to kick off this event because we have so much to say today. I want to thank our sponsors and our friends, obviously our consular section, our speakers today, but I will let this all be done by our Chairman, Ruda. So good morning, Ruda.
Good morning, everyone. Thank you all for joining us, and thank you for taking the time out. I'm sure we're going to have a really, really informative session. My name is Ruda Prabhatopi. I'm the chairman of the Canadian Business Council in Dubai. And for the last 25 years, we at the CBC in Dubai have really been focused on helping Canadians and Canadian alumni build relationships and build their knowledge in order to help them succeed in their business endeavors in the UAE. One of our core objectives for this year has been to create opportunities for our members to meet in smaller circles that more closely align with their interests and specialties. And we call this initiative the CBC's Connect Groups. And we've been really, really focused on bringing these Connect Groups to life over the last year. A successful event yesterday, which was the inaugural event by the CBC's Technology Connect Group focused on artificial intelligence. And today, I'm proud to welcome you all to the inaugural event, creating a platform for Canadian and Canadian alumni entrepreneurs based in the UAE to share their insights, to share opportunities with one another, and to really help each other grow and sustain their businesses. And one of the avenues through which we will be pursuing that will be by giving entrepreneurs and business-minded individuals amongst our membership knowledge and information about opportunities that may arise over the coming time frame. And so that's the context within which this event is taking place. I have the honor of introducing our speakers. I'll start with the crew from ENBD. First among them is Khadija Haq. Khadija joined ENBD in 2011 as one of the founding members of its research team and really helped build the bank's macroeconomic coverage in GCC and wider MENA region. She has been covering emerging markets for over 20 years. And prior to coming to Dubai in 2008, the heady days of 2008, Khadija was the vice president at Deutsche Bank in London, covering several countries in Eastern Europe, Middle East, and Africa. Joining her will be Ed Bell, who is a senior director of market economics at ENBD, who leads their analysis of financial and commodity markets with a particular focus on interest rates, foreign exchange, and energy markets. So all of the most technical and nerdy economic stuff that I'm excited to hear about from you, Ed. Prior to joining ENBD, Edward served as a senior commodities analyst and as an emerging market economist for a leading independent economic consultancy in both Hong Kong and London. And he is a member of the CFA Society of the UK. Last and certainly not least, our next speaker, the speaker opening up our agenda for today, will be His Excellency Consul General Jean-Philippe Lantour. Jean-Philippe joined the Department of Foreign Affairs and International Trade in 1997, where at headquarters he was the director of the Clean Technology, Infrastructure, and Life Sciences Division. And in his overseas capacity, he has served as a trade commissioner in Seoul, in Kuala Lumpur, in Colombo, and as a political officer in Washington, and as an international business development program manager in New York City from 2011 to 2016. I am incredibly excited for this panel of speakers, ladies and gentlemen. I won't take up too much of your time, but suffice it to say that these three individuals are the closest thing that we get to celebrity economists and celebrity commentators on both the UAE economic situation as well as the Canada-UAE economic situation. And so without further ado, I'll hand the mic over to His Excellency Consul General Jean-Philippe Lantour.
Thank you very much, Ruda. Always a pleasure to join CBC Dubai, and I want to congratulate you on taking things to the next level with the launch of your Connect groups. I think you're going to bring a lot of values to the Canadian business community in Dubai with those more focused networking and information exchange groups that you talked about. It's a pleasure for me also to join Katia and Ed this morning. I really look forward to hear what you have to say, because it will help me to also determine how we plan our year ahead for the consulate. You know, I was thinking back to a talk you guys organized. It was one of your first CBC Dubai webinars last year, as we got into the lockdown here in Dubai, and at the time I thought, you know, Dubai and the UAE are really suffering, because when the sectors that they depend on the most are really impacted. So tourism, hotels, restaurants, and so on, and the oil industry. But at the time, I also thought that the UAE has all the ingredients to come out of this crisis a winner, to come out and to rebound quickly. Now, fast forward to today, where we see the light at the end of the tunnel. We really think that the UAE has done a great job in balancing the implications of the health requirements related to the pandemic and the support to the economy. And indeed, we see that with the really quick deployment of vaccines here, the UAE is well positioned to rebound from what's happened. Last year was not all bad news, despite the pandemic and so on. For Canada-UAE trade, it was a banner year. Our exports from Canada to the UAE were up 17%, and our bilateral trade now exceeds $2 billion Canadian dollars. So this was a great year for bilateral trade. That increase in export was underpinned by the contribution that Canada makes to food security in the UAE. So our food exports, our commodity products exports went through the roof last year. And this is driven by the fact that Canada is a reliable supplier of food commodities for the UAE, but also a reliable supplier of quality and sustainable food. So the demand is there. The demand was strong, and I see it continuing into the future. 2020 also saw some significant announcements regarding investment by Canadian organizations in the UAE and significant partnerships. So I'll share two examples. One was the Ontario Teachers Pension Fund and Brookfield's Asset Management partnering as part of a group to acquire 49% of ADNOC's pipeline assets. So that was a deal worth $20 billion US. And we also had Caisse de dépôt, so that's the Quebec pension plan, that doubled up its implication, its involvement with DP World. They have a joint vehicle where they invest in port assets jointly, and they are so happy with that vehicle that they doubled up, and it's now worth over $8 billion US. So these are some of the examples of what we saw in 2020. So we saw a lot of good momentum, economic momentum in the Canada-UAE relationship. On the Canadian economy side, it was 2020 was a year of extremes. So in Q2, we had the worst economic contraction in the history, in Canadian history, basically. And it was followed in Q3 by the best economic expansion in Canadian history, right? So as the lockdown came into effect, the economy contracted, but quickly rebounded. For 2021, what is the outlook? So Q1, it's not looking great because we've been going through the second wave, and so some of our economies have gone into more of a lockdown mode again. So Q1 should be a contraction again, but things are looking great for the rest of the year, and we're expecting a strong economic rebound. The economy is reopening up. We're seeing vaccines. Vaccines are going to be the key, and I'm sure our speakers will talk about it, but vaccines are going to be the key this year. Vaccines are being rolled out at an accelerating pace. We're seeing stronger foreign demands for our commodities, and we're seeing so when we look at the rest of the year, we're seeing a good story coming out of Canada as well. When I look at Canada and the UAE, our team, what are we focused on? And I want to share that with everybody, because those are the sectors where we see the most likely the highest likelihood of success between our two countries. So one is healthcare. Like, not a surprise, healthcare is top of mind right now. This is a sector we were working on quite a bit before the pandemic. It's going to remain our top priority. I mentioned food and food security. This is a natural area for Canada and the UAE, so that will continue. And the other one I want to highlight is the clean technologies. The clean technologies and energy sector. This is a secular play. We're going to see, as the world is focused on addressing the impact of climate change, we're going to see this continue to dominate the agenda for many years. We find that the UAE is highly receptive to what Canada has to offer, given its clean technologies leadership. So that should continue to be what we focus on. But the big prize this year, being the Consul General of Canada in Dubai, is obviously Expo 2020, which will start in October 2021. So we really see this as an opportunity for Canada to showcase and to make things happen. Our involvement in Expo is really focused on trade and investment. That's the underpinning priority for Canada. We will absolutely focus on those three sectors I mentioned during Expo. Our trade commissioners are planning tons of events, so we should see a lot of traffic, either in person or some of it. I think virtual will remain a thing as we come out of the pandemic. So some of the events might be hybrid in format. But we're going to see a lot of involvement by Canadian firms here in the UAE. Look, based on what I talked about, what the good news on the Canada-UAE trade and investment relationship, recovery momentum that we're seeing, and Expo coming up, I think this is a great time to listen to our speakers from Emirates NBD. To hear what they have to say about the outlook for this year. I really look forward to your presentation, Katia. And so thank you for having me this morning.
Great, thank you, Your Excellency, and thank you to CBC for inviting us to address you all today. I'm going to share a presentation which we'll try and keep brief, because I'd much prefer to answer questions than simply talk to people about stuff they may or may not be very interested in. So I'm going to spend a few minutes talking about the macroeconomic outlook for the region, particularly the UAE, and then I'll hand over to my colleague Ed, who will talk through more of the oil-related outlook and what that means potentially for that very important sector going forward. So just to start with what we're seeing in terms of the outlook for the UAE and the GCC more broadly, the first point to note is the external backdrop for the region is improving dramatically, and that's really going to be the underpinning of growth, or the recovery rather, in 2021 and 2022. So we expect monetary policy to remain accommodative for an extended period of time. We had Fed Chairman last night reiterating to the Senate Banking Committee that the Federal Reserve would continue with asset purchases and that interest rates would remain low for an extended period of time. They want to see employment come back to where it was pre-pandemic, and they also want to see inflation. They want to see inflation rise and are willing to allow it to overshoot before they start to take steps to tighten monetary policy. So that is very supportive for this region, given that we are pegged to the US dollar, which means interest rates here are very much determined by interest rates in the United States. Fiscal policy globally is also going to remain supportive to varying degrees. So we're expecting obviously more stimulus from the United States. We've also seen significant support from the Eurozone, from Asian economies as well, to try and prime the pump, if you like, so that as soon as restrictions are lifted on activity, you will have pent-up demand coming back in because consumers have cash in the bank, companies have been provided support to survive the shutdowns, and so hopefully they will be able to recover much more quickly than if that fiscal support had not been provided. And that's quite an important factor to remember when we're looking at what is going to happen in the region versus where we are in the rest of the world. And then we also have a much stronger expectation for global growth in 2021. So the IMF actually upgraded their forecast for growth to 5.4% a couple of months ago. And that again is encouraging in the context of what it means for rebounding global trade and just generally a pickup in demand, not just for commodities, but for other goods and services as well. And then one sort of corollary of accommodative monetary policy in the US is a weak dollar, which has been the case for the last year and a bit, and it's a theme that we expect will remain in play through 2021. And again, because the GCC economies are pegged to the dollar, a weak dollar helps to restore some competitiveness, which especially in the services sector have been eroded over the last several years as the dollar has been much stronger. So what are we seeing for the UAE? Well, it's been a slow start to the year. And I think if we look at what happened in 2020, we saw in the second quarter with the lockdowns being imposed, a significant contraction in the non-oil sectors of the economy. You can see that with the PMI survey data in the chart at the bottom. When those restrictions were eased in the second half of the year, we didn't see a very sharp rebound. So there was some element of stabilization and yes, some recovery in output, but overall it wasn't really enough to compensate for the contraction in the second quarter. And so overall, we still anticipate, we don't have official numbers yet, but we think the economy contracted by almost 7% last year. What does that mean for 2021? Well, we're not expecting a V-shaped rebound in the sense that it would make up for the contraction last year. We're only expecting the non-oil sector to grow by around 3.5% in 2021. Now, given that the UAE has been so successful with rolling out vaccines early, yes, that does bode well. But at the end of the day, we didn't see the same kind of direct fiscal stimulus in the UAE and the rest of the GCC as we saw in other developed economies around the world. So the focus for policymakers in 2020 was to make sure that there was sufficient liquidity in the banking system. They provided a lot of additional support through the central bank and through the banks to make sure that households had some relief on debt repayments, to make sure that companies had access to additional capital, and to make sure that there was sufficient liquidity, that interest rates remained very, very low. But there was no direct support for households in the form of wage support or unemployment benefits. And part of the reason for that is that there is no tax, no income tax or corporate tax in the UAE. So they don't have the same kind of tools that can be used to refund tax when times are bad, because they're not collecting tax revenues when times are good. So the channels for support perhaps are more limited in the region than they are in other economies. So what we've seen then is a significant loss of employment in the private sector in the UAE. And this is particularly important because of the unusual demographics. So around 90% of the UAE's population is expatriate, and the vast majority of them are employed in the private sector. So if you're seeing jobs being lost in the private sector, which we have seen through the course of 2020, then that really affects expatriates who then would find it difficult to remain in the UAE without employment. And so you then have consequences of declining population, which then has second round effects for future demand, even once activity is normalized or once restrictions are lifted. You just have a much smaller base for consumption. and a recovery in consumption than you would have if people were to remain in place and had some money in the bank. So these are some of the challenges which I think are going to weigh on a recovery in the UAE and the rest of the region. It's a demographic challenge, and it's also the fact that there wasn't the same kind or the same extent of direct fiscal support to the private sector as there had been in other economies. If we look at the oil sector, Ed will talk more about that later, but that is definitely going to remain a headwind to growth. And just as an indicator of the recession in the private sector last year, a great indicator is the private sector credit growth figures for the UAE, which show private sector borrowing actually declining post the pandemic or in the second half of last year, when ordinarily you would have expected businesses to draw on additional credit to fund their continued operation. In fact, what we saw was government-related entities and public sector companies actually benefiting the most from that additional liquidity that was pumped into the banking system. So there again, there's a bit of crowding out that's been happening in the UAE's non-oil economy, where private sector companies perhaps are losing out in terms of liquidity support provided by the government. In terms of Dubai specifically, just to touch on the key sectors that His Excellency mentioned earlier on, transport, logistics, hotels, hospitality were extremely hard hit in the second quarter of last year, and they do account for a significant chunk of Dubai's GDP in particular. But I think what's encouraging as we look ahead is that when we look at the numbers for the travel and tourism sector in December last year, when there was a travel corridor in place between the UAE and the UK and parts of Europe, people were allowed to travel, and they did. So we saw hotels in Dubai have a bumper December, notwithstanding the pandemic and restrictions in the rest of the world. So I think what that suggests is that when people are allowed to travel again, hopefully from the summer onwards, they will. And I think that is something which will help the hospitality sector in Dubai in particular recover, given that it has a reputation for managing the pandemic very well from a operations perspective, both in hotels and on the airlines. And of course, given the high levels of vaccination in the UAE as well, there is a sense of comfort that it is a safe place to come on holiday. And I think that's very, very important, particularly as business travel is going to take a lot longer to get back to where we were pre-pandemic. Real estate is another big sector for Dubai. We obviously have seen quite a significant decline in residential and commercial real estate property over the last several years, well before the coronavirus. But what's been interesting is that the low interest rates that we have seen over the last year, as well as some easing in lending restrictions, has seen a pickup in demand for residential real estate in the secondary market. We have seen some stabilization in price at the end of last year, and we are seeing signs that certainly in pockets of Dubai, we're seeing prices picking up. However, the issue that we have that's weighed on the sector over the last several years has been one of too much supply. And to some extent, the pandemic has stopped new projects being launched, so that's been quite helpful. But there is still quite a lot of supply that is due to come onto the market over the next 2 to 3 years from projects that were launched in 2018, 2019. So we're not expecting a sharp rebound in real estate prices in Dubai, but we do certainly think that further price declines from current levels will be much more limited. And hopefully as we get into 2022 and beyond, and we see some recovery in demand, we may start to see prices stabilize and start to move up. And again, just to tie things in with the sectors that His Excellency mentioned in his presentation, from the UAE side, the government has been very clear that its strategy going forward has changed. It is no longer going to be simply building things in the hope that that's going to be sufficient to generate growth. There is a recognition that the low-hanging fruit of infrastructure development has been picked, and they have to be a lot more careful about where they invest going forward to be able to yield the kind of growth that they want to see over the next 10 and 20 years. And so the areas that they've highlighted are technology investment, including fintech, There's been a tremendous amount already of investment and growth in that sector. It is still a very small sector as a share of GDP, but it's one of the fastest growing. And that I think is going to continue. There's a significant amount of information that's being exchanged in joint ventures with Israel, which is a fintech leader globally. And that I think is going to continue to drive growth in that sector for the UAE. Food security and agri-tech, again, given the impact of the coronavirus, the fact that the UAE imports 90% of its food really brought home the importance of food security for the country and the importance of diversifying supply chains. The UAE will never be able to produce enough food domestically to meet the demand, but what they can do is grow or at least diversify and move up the technology chain in terms of what they can do at home, and then invest in that kind of technology in other places as well. It's all very well owning, a farm in Africa, but if you can't actually fly the food from there to your home country when borders close, then it really doesn't make a huge amount of difference when it comes to securing food supply. So I think that is strategically going to be an incredibly important sector for the government going forward. And then also clean energy and clean technology. Already the UAE has made significant strides in terms of producing more energy domestically from solar power and other renewables, as well as nuclear power, but they want to do more. So the target is that 50% of the UAE's energy consumption must be clean by 2050. And again, there is a huge amount of money that's been allocated to try and achieve that goal. So I'm going to turn it over now to Ed, because, despite the diversification process that we've seen and the progress that has been made over the last decade or so, this economy still remains quite vulnerable to oil prices and quite dependent on the oil sector, as does the rest of the region. So Ed, do you want to pick up from there?
Sure. Thank you very much, Khatija, and good morning. And thank you for allowing both Khatija and myself to participate in the call today. With respect to looking at the energy sector and the oil market dynamics, I'm going to be talking a little bit about it from a short-term perspective, as in what we've endured in the last year and what we're expecting for 2021, and then draw on some of the themes that both Khatija and the Consul General have mentioned for more of a medium to longer-term outlook, and some of the economic strategy implications that could be affecting the outlook for the UAE's energy mix on a longer term basis. So certainly last year was an extraordinarily difficult year for the oil market, no matter what part of it you were participating in, either as a consumer or a producer. We had this enormous drop in oil consumption as the COVID-19 pandemic essentially shuttered all economic activity and saw a complete collapse in mobility. So we had a roughly 9 million barrel a day collapse in oil market. Just to put that in context, if it sort of sounds like a number out of thin air, the oil market normally grows by about 1.5 million barrels a day. 2 million barrels a day of demand growth would be a particularly strong year. So a 9 million barrel a day drop in consumption was an absolute calamity. This year, the outlook is expected to be for an improvement. So most of the major energy forecasting agencies, whether you look at OPEC, the IEA, International Energy Agency, or the EIA in the United States, are all expecting to see a strong recovery in consumption, somewhere in the order of between 5 to 6 million barrels a day. So that would still leave us below pre-pandemic levels. Nevertheless, the oil market recovery should be reasonably broad-based. So we've seen a few Asian economies which have had their handle on the coronavirus pandemic. They got a bit more control in it, particularly in China earlier in 2020. They're emerging a bit stronger in terms of the oil market consumption story for this year. For many developed markets, it does look like it will be pushed back into the second half of the year when we start to see more of an impact from vaccination campaigns. So I think the market has seen the early signs of vaccines being rolled out in places like the UK, the United States, and other major developed markets as a positive, but it's not necessarily translating into an immediate change for oil consumption. Now, the supply story, thanks, Khatija. mirrored what we saw in the oil demand. We had an enormous drop off in oil production in response to prices collapsing in Q2. If you recall, April, between March and May was just a terrible time to be in the oil market or covering the oil market in any kind of sense. We did end up going negative in the WTI market as well. So we had this enormous drop off in, let's say, market-oriented producers, places like the United States, like Canada, Brazil, North Sea production, and also a response from OPEC and their allies, OPEC Plus, where we had this agreement to cut production by 10 million barrels a day from April last year, and then that would be phased back, those barrels would be phased back into the market. Now, in terms of the outlook for 2021, we are expecting to see a muted recovery in non-OPEC production of a little bit less than 1 million barrels a day. And most of that is going to be contributed by countries that are not part of the OPEC Plus arrangement whatsoever. So OPEC Plus considers the core countries of OPEC like Saudi Arabia, the UAE, Iraq, Kuwait, along with producers like Russia, Kazakhstan, and some other producers where the oil sector forms a major part of the economy. So for the producers that are completely outside of that framework, we're expecting to see decent pickup in growth, supply growth from countries actually like Canada, like Brazil, and production in the North Sea, but it will be limited compared with what we've seen in the past. The big question I think that everyone is watching at the moment is what the supply response will be from the United States, where we saw a very rapid drop off in terms of production, and we're only starting to see a return to capital investment coming into it at these very early stages. Now, one of the major effects of the enormous drop in demand and supply was that you had an inventory surge last year in 2020. So OECD stocks, those in the developed markets, which are reasonably transparent and relatively easy to track for anybody tracking the oil market, blew out to more than 3.2 billion barrels of inventory. Now, that number might seem large, it might seem small if you don't really have anything to gauge it against. And what I prefer to do is look at how well the level of inventories can meet actual oil consumption during those periods. So on average, among the developed countries, most economies try and keep roughly 60 days worth of oil consumption in inventory at any one time, largely in commercial stocks. And that helps to insulate against any kind of price shocks. And that dates back from the kind of a policy from the 1970s. So roughly in the past 10 years, it's been about 60 days, give or take, on average. Last year, that days of demand metric rose to over 85. So there was a very short-term, sharp deterioration in oil prices in response. And that's why we've seen the oil inventory number, rather than just production itself, be the real target for OPEC and OPEC Plus policy. So just go down to the next slide. What we've heard from OPEC is that they're continually trying to target a 5-year rolling average for the oil inventory number. Now, that would certainly bring oil inventories down compared with where we saw last year, but the issue with a rolling 5-year average is that it doesn't really take into account any changes in consumption as well. So you might see that that rolling 5-year average, when we start to go into the coming quarters, would actually start to increase quite rapidly because of the huge increase in inventories we had last year. So it would probably be a less valuable metric to try and get inventories down toward. So we look at targeting that days of demand number, and we think that if that was the target, then we'd actually see a better improvement in the oil market in terms of the price response that would be more conducive to growth and to supporting the economies here. Now, the big question for 2021, beyond what's the reaction in the United States, is what is OPEC Plus actually going to do? Let's go to the next slide. Thanks, Khadija. We actually have an OPEC Plus ministerial meeting next week, at the end of next week. And you may recall that in December, OPEC Plus decided to move from just meeting twice a year among all the oil ministers of the producing nations to actually meeting on a monthly basis. Now, that might seem like a choice to become more engaged and more responsive to conditions in the oil market. The risk I see there is that you have roughly 40% of the oil market that could be responding to very short-term oil price signals that may not last. So in the past fortnight, we have seen some extraordinary stress in the oil market globally because of what has been happening in the United States, particularly in Texas, when unusually cold weather has essentially frozen oil fields shut. Now, that is not necessarily a long-term variable that countries who are entirely reliant on energy inputs for their export receipts should really be targeting in terms of the boost up in prices. One of the other factors is beyond the overall scale of how deep the production cuts that OPEC Plus took, the roughly 10 million barrels a day of production cuts, was just how long they were meant to be in place. OPEC agreements have generally been in sort of the order of maybe 6 to 12 months, but this one from the middle of 2022 was targeting that it would only expire in 2022. So it was quite a long period for countries to have to endure lower levels of production. And we're starting to see more and more resentment among some of the key producers within OPEC core itself, as well as OPEC Plus, about the level of production restraint that they're holding off of the market. So for instance, here in the UAE, roughly 1 million barrels a day of capacity is currently being held off the market. And that's a lot of market share that's being given up or being ceded to producers that aren't bound by the terms of the OPEC Plus agreement, or even within OPEC Plus itself, countries that may not choose to adhere to the terms of the deal as strictly as possible. So oil market diplomacy is a crucial variable for the oil market remaining healthy this year in terms of price responses. And we can't rule out that we would have a similar scenario to what we saw in March and April last year when we had this price war. Now, I think what we've experienced in the last year and a half has been this sharp bust and boom in oil prices, where we've had a very rapid increase this year with oil prices in sort of mid $60 a range. And I think it's worth bearing in mind, considering the diversification strategies that Khadija has mentioned earlier, that the medium-term outlook for most of the oil producers here in the GCC still remains quite positive. So we actually still see a fairly robust oil demand picture going forward. Just to put it in a little bit of context, oil demand per person in the United States, if you sort of take that as your benchmark, is roughly about 20 barrels per person per year. In an emerging market as large as China, it's still only about 3 barrels per person. An economy like India, it's significantly less than that. And if you look at other emerging markets, there is still significant scope to converge on developed market levels of oil consumption. If we were to say have China consume just 25% of the per capita consumption of the United States, then the entire country would be consuming over 20 million barrels a day of production, 20 million barrels a day of demand, compared with roughly about 14 to 13 that we consume at present. So that does set us up for a reasonably strong outlook out to say the mid 2030s, and I think that's bound why you're seeing companies like ADNOC, like Aramco, make these long-term investments in oil market capacity, so actually adding production capacity to meet that. Now, that does run up against some other longer-term risks, though, of the energy transition, which the UAE is also trying to meet with some of its clean tech objectives. So we've seen increasingly oil as part of the global energy mix continually lose market share to the cost of renewables increasing significantly. Gas has also been rising quite considerably as well. So we probably see more of a shift in the longer term, say kind of 2030 to 2040 time frame for gas to make up more of the energy mix in terms of production, export, and consumption across the region. The issue we still see is that, yes, we've had these enormous diversification strategies across the region, but by and large, the GCC is still a hydrocarbon-focused economy. The level of investment, foreign direct investment, still underperforms some of the other smaller and more trade-oriented economies that we see in the region, say Egypt, or if you look at other comparable sort of level of development economies like Thailand or South Korea, it's still quite far below in terms of overall FDI. And we'll just go to the last slide. One of the other issues that is a little bit harder to put a significant number on, but is the fact that energy is actually becoming a less crucial variable in the global economy. When we look at the level of actual money that we're spending on energy as a share of the total consumption basket, that has been in quite secular decline since about the 1980s. Now, it does go up and down when we have these kind of price spikes in the oil price that we saw, say, in 2008, but nevertheless, improvements in energy and efficiency, other alternatives such as renewables, the electrification of everything, is leading to oil becoming a less and less crucial part of the energy mix and indeed the economy mix, and it could be posed to lose significant ground going forward as we see that the cost curves and across a lot of renewables is coming down considerably as well. I've talked quite a bit. I'm going to tie myself off there, and I think we do have some scope for questions and answers, so I won't want to chew into that much more.
Fantastic. Ruda, I think it's time for you to chime in. Can you hear us? Great. Sorry about that.
So
Thank
we
you.
have, so thank you very much, Diana. So we have one question in the Q&A chat, and I have a few questions that I would like to pepper you as well. The question was about gold investments, and then I guess the broader commodities market as well. Do you have an outlook in terms of how precious metals are going to perform, and then in particular, just how any particular commodities outside of oil? Any outlook in that respect?
Sure, certainly. So our outlook for gold is actually a little bit negative this year. We expect to see that other asset classes that investors might choose between will probably be outperforming the gold market. Certainly, we've seen a strong run up in equities, barring the last few days. We've had a bit of a correction. And also you're seeing a real surge in government bond yields, even in places where you would think it's kind of not possible. You've had a big uptick in bond yields in Germany, for instance. Still negative on the 10-year, but they've improved quite a lot. So all of those variables to us detract a little bit away from the gold market view. And indeed, I kind of always view gold as a sort of residual of what's happening in all other financial markets. So if you want to be really strong on gold, my view is you have to be really negative on pretty much everything else. And we don't think that's the case this year, in line with improving economies that should allow equity markets to perform quite well. Yes, we've had this run up in bond yields, so implying a sell-off in the bond markets, but at a certain point, I think the bond yields, for instance, in the United States at around 130, getting up to almost 150, could become quite attractive for people to go back into those funds. Outside of the precious metal market, though, the commodities complex, particularly with, let's say, industrial metals, I think is quite positive, quite constructive. Unlike the oil market, where we've had a very strong response in terms of prices, with Brent futures up over 20% since the start of the year, you still have this enormous overhang of production that is there being left off the market simply on policy decisions alone. So next week we could see OPEC. I'm not saying they would, but we could see OPEC decide to add all those barrels back into the market. So there'd be roughly 7 million barrels a day of production coming back onto the market. It would flood the market and crash prices as a response. You don't have a similar kind of production and capacity response in other industrial metals. There's not the same kind of level of, let's say, copper production that's waiting off the market for prices to come back. So the outlook there, I think, looks fundamentally excuse me, more sound than necessarily having the oil price rocket ahead on a medium to longer term basis.
So I think you made a really interesting point, Ed, about how what happens in gold is kind of the residual of what happens in all the other markets. So then that, of course, begs the question, 2020, pretty good year for equities and for global equities in general. What do you have a particular point of view on how equities will perform? And I know that's a really, really broad question, but do you have a general outlook on how developed and then emerging market equities will perform over the coming year?
Yes, I can take the head to say we actually don't provide forecasts for equity markets. It's not, but our view would be largely that if you have a well-performing economies that are in recovery, and we think that's going to be the case both in developed markets and emerging markets, and that it's going to be more synchronized. Whereas last year, we did see outperformance among developing or emerging economies relative to developed markets, but most of that was down to China. This year, we see the recovery in emerging markets more broad-based, so expect to see strong levels of growth, both in China, but as well in places like India, where the government itself is targeting growth sort of around 11%. So the outlook is looking a little bit more shared in terms of who's going to be benefiting from growth this year. And I think with a policy stance from central banks virtually everywhere to keep financing conditions accommodative and a positive growth story, I don't want to say equities are going to do this, but those look like positive ingredients for an equity story to me.
That's really interesting. One of the other sectors that's of really pivotal importance to the UAE or Dubai's economy in particular is trade, global trade and logistics. How do you think that sector will perform? Do you expect shipping costs to change dramatically over the course of this year? I know there's quite a bit of volatility in that sector over the course of 2020 as well.
I think I'll take that. So, I mean, yes, we've seen a bit of a spike in shipping costs, really because of capacity issues. But I think more broadly, when we look at the trends in global trade, we actually saw global trade fall well before the COVID pandemic hit. That just made it worse. So we really saw a big drop, or a slowdown rather, when the US imposed those additional tariffs on China in the middle of 2018. So from the middle of 2018 through, I think the following sort of 12, 18 months, we did see a slowdown, and in fact, at one stage, a decline year on year in the volume of global trade. We sort of started to see that recover, and then the COVID pandemic kind of pushed it back down again. So I think, going forward, we are quite optimistic that when you have economies reopening, you've got people who they're already boosting spending on goods, but they have quite a lot of cash in the bank, and there is quite a lot of pent-up demand. So as economies reopen, we are expecting the outlook for global trade volumes to look much better as well. We have seen a recovery over the last 3 or 4 months, based on data that's collated by one of the research houses in the Netherlands, and we're expecting that trend to continue. So for an economy like Dubai, I mean, that's going to be a big driver of a recovery in this region as well. We are expecting cargo volumes to pick up, both shipping and air, that's going to obviously feed through to the broader logistics sector as well. The other big driver, I guess, in the region for trade and trade flows is when you look at the investment plans in Saudi Arabia, for example, a lot of the materials and equipment that will be needed to see through those investments are going to come through Dubai or the UAE. And so that as well is going to drive, I think, volumes of trade intra-GCC, as well as from east to west.
Okay. Thank you, Khadija.
Can I ask a question?
Yeah, of course.
I know I'm supposed to answer questions, but I have something that I think about a lot. This is a question for Katia, I think, and notwithstanding what Edward says about the importance of oil to the UAE economy, that's still there, and we understand that. The UAE holds a world record in that its large-scale solar projects provided with the cheapest electricity in the world. Like it blows every other source of electricity out of the water, right? The UAE has been able to source huge amounts of megawatts at under 2 cents per kilowatt hour. So, for me, I look at those prices and I think that's a game changer in terms of economic development, industrial opportunities, and competitiveness, because energy is always such a big component of many of the industrial processes out there. What do you see as is the impact of that drive to produce more and more of this very, very cheap, the lowest cost electricity in the world?
Yeah, I mean, it's a great question. I think in the interim, or in the sort of, I'd say, next 5 to 10 years, the focus is on having the UAE rely on solar power, nuclear power for its domestic needs, and then that then allows it to have more barrels of oil and gas to export, to be able to generate more budget revenue. So I think in the first instance, it is really to try and reduce obviously the carbon footprint of the UAE's own economy, but also just to free up oil for export. But I think going forward, yes, there is I mean, Ed would probably be able to say whether this is feasible or not, but there's no reason why, in my view, the UAE couldn't start exporting, electricity generated from solar power, to neighboring countries in the region through a GCC grid. So yeah, I think overall it's an interesting sector and dynamic going forward. I think the issue with oil, the reliance on oil, it comes down not just to economic dependence, but the budget. So when you look at the structure of the UAE's economy, oil is only around 30% of GDP. So on that basis, it's a very well diversified economy. But when you look at the budget, a much bigger share of government revenues comes from oil sales. And so when oil prices fall, when oil production falls, it has a much bigger impact on the budget than it does on GDP. And so what that also means is that there's less money for the government to spend on other things. And that's the issue, I think, which they're trying to grapple with. And the first attempt at it was introducing a value-added tax back in 2018 to try and diversify the sources of revenue, to look at other ways of boosting non-oil government revenues so that we don't have such a massive outsized impact on budget finances when oil prices fall sharply or rise sharply. And one of the reasons why governments in the region have not been able to provide a lot of fiscal stimulus is because of the impact of the oil price collapse last year on their budgets. So, it just reduces the flexibility to be able to maintain a certain level of spending. When we look at the budget for last year, the UAE consolidated government spending actually fell by around 15% year on year in the year to September, which is the data that's being published. You compare that with the growth in spending in governments, in other developed economies, and it's a marked contrast. We had Saudi Arabia cutting budget spending this year as well to try and rein in a deficit. So I think the diversification story, yes, it's about diversifying GDP and creating jobs, but it's also about diversifying the sources of revenue and reducing the budget's reliance on oil revenues.
Thanks, Khadija. We have a question from Jeffrey El-Bustami. Given the accommodative monetary policy in the US, when do you foresee inflation catching up and meeting or exceeding the Fed's target? And then when do you expect that the UAE to then start importing some of that inflation? Jeffrey has a second question related to the banking sector, which ties in with something that I wanted to ask. So I will ask that in a second. What do you guys foresee in terms of course, inflation is a hot topic these days. A lot of conversation taking place in terms of what people see inflation taking place. People are attributing the rise in the price of Bitcoin to expectations around inflation. What do you foresee for the coming year, or at least, for the coming year, but then also in the longer term over the 3-year span?
Okay, I'm going to just say a couple of things and then Ed may want to add to it. The Fed has maintained, and we would agree with this, that we will see inflation picking up in the US over the next few months, but that is because of a base effect. So you had a sharp drop in prices last year because of the pandemic. And so naturally, there's going to be a year-on-year growth figure when you get to that point in 2021, especially as economies reopen, demand picks up. There's probably a shortage of inventory of a lot of goods as well in the US, which is going to contribute to inflationary pressures. But those things the Fed considers transitory. When you look at their forecasts for core PCE, which is their preferred measure of inflation, they don't see that going above 2% until the end of 2023. So, that is still quite a ways away. Now, that could change, obviously, and the Fed will be updating their economic forecasts at the March meeting. So we may see some adjustments to that. But we're certainly not in a stage where we should worry about inflation at 4 or 5%. Even if it gets above 2%, that's not necessarily a bad thing, right? So I think that's one factor to bear in mind, is that some inflation is good. In terms of the UAE's importing inflation, the biggest drivers of inflation in the UAE are housing costs and food prices. So if you consider the fact that housing is really still in an oversupply situation, that's not going to be a source of inflation in the next year or so. And similarly, okay, food prices globally are rising as part of the broad commodity complex. But so far, we haven't seen much indication of that feeding through to UAE food prices. There was some discussion about potentially putting in price controls to try and prevent that from happening. But we've actually been in a deflationary environment in the region for the last year and a half. And there's no sign of that really changing at any point soon. And if it does, again, if you go from -4 to 0 or +1 or +2, that's probably a good thing. Yeah.
Very interesting. Jeffrey's second question ties in with something that I wanted to ask about the UAE banking sector. So, Jeffrey's question is the UAE the banking sector going to fully recover this year? What are the threats that could hinder growth in this sector? And my related question, and of course, this is a little bit of I'm asking about data that is in most cases behind the black box. What data have you seen in terms of defaults and in terms of allowances for bad loans at the bank within the banking sector? I know a lot of liquidity was provided to support the banks, but what is that data saying at this point in time? And how will the banks react over the coming year?
Okay, we have seen banks taking increasing provisions, but I think it's quite difficult to see where the defaults are going to be because the TESS program that was the central bank's liquidity provision, it's been extended to June. So that means lenders or borrowers have another 5 months to pay back what they have borrowed and to benefit from delayed payments, etc. So we're not really going to sense of which lenders are not going to pay back until after that time has passed. Wow. Having said that, from what we have seen anecdotally, quite a lot of companies that took advantage of that free money, if you like, or the extensions have already started to come back into compliance already. So the banks are already starting to pay back the money that they withdrew under TESS. So that suggests that actually it's not all going to end up in default, that there is some resumption of normality and people are paying down the debt, having taken a few months holiday or extension on payments, etc. So we will have to wait to see, what that end number is going to be on defaults. But banks have provisioned. They do have a lot of liquidity. They are well capitalized to withstand any deterioration in the book. And at the same time, there are already signs of recovery in the sense that people are paying back.
Cool. And do you think that will then translate into private sector lending over the coming year, or is that relationship not a one-to-one?
So the private sector lending story, the lack of it I think speaks to a weakness in demand for credit. So if you as a private sector company are not confident about the outlook, you're not going to rush to the bank to get a loan to, potentially expand your business or to see through. You're going to look to try and cut costs as much as possible, which is what companies have been saying in these PMI surveys. They're focusing on reducing costs. They are not rushing out to borrow money. And that is really reflecting a huge amount of uncertainty about the outlook. So once companies are more comfortable that things are going to improve, I think we may start to see a natural pickup in appetite and demand for credit.
And I'm aware that we're running out of time, but I'm just going to end with a slightly broader question. One of the UAE government's sort of main objectives in terms of trying to create a deeper base of knowledge workers has been to try and drive productivity growth and to improve the UAE's productivity growth. You mentioned earlier that employment is coming down because of a exodus of presumably of expats. Do you think that the government's efforts to import higher quality workers in order to drive productivity growth will help counteract some of the effects of the dip in employment, or are the two effects so lopsided that one just simply cannot overcome the other?
No, I think what we would need to see for people coming back is for jobs to be available, for companies to be hiring. And at the moment, as I said, because companies are telling us that, or telling the surveyors that they are focusing on reducing costs, there's not a lot of hiring going on at all. I think in the January PMI survey, there was no change in the employment index, and that's the first time that it was not negative in over 11 months. So you know, until you start to see private sector companies hiring, what is going to bring people back to the UAE? Yes, I think the focus is very much on trying to attract talent in those technology sectors where both the government and the private sector perhaps need to catch up a little bit. But you know, that's still a fairly small segment of the broader economy. If you look at where the biggest segments of Dubai's GDP come from, or where they are, it's in wholesale and retail trade. It's in manufacturing. You know, these are quite sort of blue collar kind of industries. It's not necessarily the high tech stuff. So I think that change is going to be more gradual.
Okay, fantastic. Well, I'm cognizant of time, and I want to thank all of our speakers, His Excellency Jean-Philippe, Khadija, and Ed. I really enjoyed this session, and I hope that all of our participants enjoyed it as well. You know, as I moved from my previous career in consulting to my current career as an entrepreneur, I learned that the relationship between what you hear at the macro level and what you experience at the micro level is often tenuous. And so as a result, there are very few economists who are able to relate the macro down to the micro. And I often find that Khadija and Ed are amongst the economists that can do that. So in that sense, I'm a genuinely deep fan. And Jean-Philippe, thank you so much for your time. It is fantastic to see the effort that the consulate is making towards expanding the relationship between Canada and the UAE. And as a Canadian living in Dubai, I also want to thank you for the incredible support that our Canadian mission has given to the Canadians living here. I think it's fair to say that at no point in the last year and a bit, last year that we've been stuck in lockdown, at no point has any Canadian had an opportunity to doubt that that Canada was here to back us up. And I think I want to thank you and the team in the consulate and the embassy in that regard. Ladies and gentlemen, that concludes our session. I want to highlight two things to put on your agenda. On March 8th, the CBC's Connect Group for Women in Business will be hosting their event for International Women's Day. And that will be taking place in the morning, featuring Her Excellency, the Ambassador Marcy Grossman, as well as Maithili Sagar, who is the CEO and co-founder of KinderPass, which is a leading sort of platform for childcare and nurseries. And then if you have found this event interesting and worthwhile, I encourage you to sign up for our follow-up Outlook 2021 event, which will focus on the tourism sector, featuring the head of tourism and destination marketing at Facebook, as well as a specialist in the real estate sector. And so that will be another fascinating event where we'll talk about these two sectors, which I think has been reinforced earlier today, are really crucial to the business environment that we deal with in Dubai. And with that, thank you very much. Thank you, Diana and the CBC team. Have a great day.
Thank you.